Thank you for being here right now, 7:48. Appreciate your being here. Long evening, but anyway, my next presenter is Mr. Mike Ryan. He's going to have some very creative tax and investment strategies. He's not going to only talk about 1031, but he talk about other real world real estate transferring strategies, exit strategies. So, looking forward to it. I mean, I deliberately did not want to ask him in too much detail what he's presenting because I want to be surprised by his presentation just as much as you should be pleasantly surprised. And I'm sure he can provide a lot of value above and beyond, what we think he can provide. So, without further ado, Mr. Mike Ryan, give it a hand.
Thank you all. I'm going to try to do a 3.5-hour presentation in 33 minutes. Right? It usually runs about an hour, and it's usually because of the questions. So if we can possibly hold the questions to the end so that we get through all of the high points, because all of this is really I'm just hitting the high points. I have tax background. I have the pleasure of occasionally working for Mr. Smith, who's been my tax person now for a decade. So, what I do for a living is for the last umpteen years, I've been doing strictly loans, but I do commercial small business as well as residential. This year I'm probably doing 50% commercial alongside of residential. I started out the business in real estate at Top Realtor, moved to California in the middle of a downturn, multi-savings and loan fiasco for the three of us that are old enough to remember that. And that's after coming out of 20 years of construction background. So I'm an investor, a rehabber, boots with a suit. I have no problem walking onto a job site. Legal disclaimer, because I can step across the lines very easy. You should not construe the contents of any of this as legal, tax, or investment advice. The information provided is a summary, is necessarily incomplete, and the tax laws and regulations are subject to change. You should consult your own legal counsel or other professional advisor as to legal, tax, and investment matters concerning the topics discussed. I will try to be clear when I know I'm stepping across the line. I'll go shh, and I'll step off the camera. Because we do a lot of things that in one jurisdiction might be considered a no-no, in another it's standard operating practice. I'm not trying to get anybody to do something weird. So what we're doing tonight is looking to identify the little-known tax deferral or tax avoidance. There is ways to avoid capital gains taxes, strategies, and then identify the areas where the strategies can be used. Talk a little bit about the pros and cons so you can start seeing a little bit, getting a feel for where you might utilize one strategy versus another. I have a crib sheet that will pass out at the end that will summarize the material pieces to aid in trying to remember, and again, this is all high level. And I ain't selling nothing. I just tell you what all I do. You need to get a hold of me, get a hold of Sealing. He can track me down or through my own information. So this is basically the cliff notes are going to be covering. There are 6 ways to defer or avoid capital gains taxes. Yes, there are 8 bullet points on the slide. Being a mortgage broker, my math is that good. 2 of them have nothing to do with avoiding capital gains or taxes, but they are regularly used as exit strategies for property. So because the tax deferral or avoidance strategies are exit strategies, I wanted to incorporate those in just to keep that real broad overview. Somebody selling property, everybody should set a baseline, because the most stress-free way you will ever deal with Uncle Sam is to sell the property and pay the taxes. There's no future reporting, there's no clawback. You can go and do whatever you want with the proceeds. It is the least stressful from that standpoint. But now how many here might think that paying taxes is more stressful than worrying about Uncle Sam asking questions? And most of us are here because we would rather not share our wealth with Uncle Sugar. But we need to know what the baseline is, and most people miscalculate this. I doubt, I haven't seen any of the Singwing nets, but I would be extremely surprised if you slipped on this. But 80% of the real estate professionals I've seen in 30 some odd years all below it on this one. They get the federal long-term capital gains taxes. Oh yeah, you sell your property, you got $1 million of gain, you're gonna have to give 200 grand to Uncle Sugar. 20%. You have investment property, you get to recapture all of that depreciation. And the rules are different if you have accelerated depreciation. I'm not even going to touch that one, just putting in the back of your mind. If you have any accelerated depreciation, be real careful before you sell the property. Know the answer. So you have an extra kicker there. Sell a property for $2 million, you paid $500,000 for. If you've owned it 20 years, you're going to have depreciation recapture on 300 grand at 25%. Not a small number. Oh, one of my favorite asides is we live in a glorious republic called the People's Republic of California. They want their piece too. California does not have a capital gains special tax rate. It is all ordinary income. And if you have $1 million of gain on a property, think about if you got $1 million on the W-2, you're not talking about the 0.36% tax brackets. You are going to, you're going to hit the lottery. The governor's lottery, that is. And the state has a depreciation recapture as well. So fast math, you're going to be sharing over 1/3 of your gains with Uncle Sam. But you'll be able to sleep well at night and you never have to worry about anybody asking you what you did. I literally have some people, this is the way they go because they don't want to worry about 90 years old having Uncle Sam ask them some dumb question. Beats me? Not me. I haven't sold anything for cash, and it's all exchanges. There isn't a registry. But this is still the baseline. So the real estate people, the people that are flipping properties, going out and knocking on doors and whatnot, this is the homeowner's reality. This is why they're still sitting in that house instead of moving on with their life. And they're scared because they don't want to write that check for hundreds of thousands of dollars. Now we move into the fun ones. Anybody here not familiar with 1031 tax deferred exchange? Cool. So I'll hit a couple of the high points. We know the time periods, but it is real property for real property. You can sell dirt and buy a condo. You can sell a condo and buy an office building as long as it's deemed real property. I'll also throw in here, we can no longer do it with our personal residences. We used to be able to. That's now called that 250 exclusion, 250 per person. People think about it as being 250 and 500. I'm here to tell you that could be $1.5 million. How many people are on title when you bought the house? 2 couples both going together and buying a house. How much is the exclusion? It's $1 million, not $500,000. $250 per person. Talk to your tax person on how long you need to have the people on title to do that dance. I have no opinion on it. 1031 exchange is done, again, with investment property. But you can do it with an owner-occupied residence. Because the current rule is you get your exclusion if you've lived in the property 2 of the last 5 years. For 1031, it needs to be classified as investment property, so you move out of your personal residence, rent it, and after a period of time, you have now reclassified the property as an investment. But you're still in that dual window Then when you sell it, you can take your exclusion money off the top, 250, 500, 750, whatever it is. You can take that off the top, tax-free, stick in your pocket, and you can exchange the rest of it. West side of San Jose, we got lots of people doing this.
That's not considered boot.
That, it's not considered boot because you're getting the owner-occupied exclusion because you lived in the property 2 of the last 5 years. But you turn it into a rental property for, talk to your tax person, I usually say 2 years because the consensus of all the tax people I talk to, if it's an investment property for 2 years, you're not gonna have any problem with look back. And so that 3rd year that has been an investment property is when you sell it. Don't miss that 3rd year deadline because then all of a sudden you haven't lived in it for 2 years. And then you exchange the rest. If you have mortgage on it, you're moving forward with mortgage and the other. This is still considered, investment property is considered passive. I always like to joke about that. It is passive only in the eyes of the Internal Revenue Service. How many here own investment property? How many here have gotten that phone call on a Saturday or a Monday morning? Toilet's backed up, heater's not working or something. At that moment in time, does your life feel very passive looking at that investment? Yeah. But it's still something to keep in mind. How passive do you want to be? Delaware Statutory Trust, also known as a DST. This is, so you're exchanging, you're using investment property only. Doesn't work on the personal residence trick. It is definitely investment property only. And let's see, I always have to check my own cheat sheet so I know what the next slide is going to be saying to me. You do have to be an accredited investor. Accredited investor is $1 million plus net worth, not counting your personal residence, is one definition. Richard, is it 200, 300, or 253? No, the income requirement for an accredited investor. Do you recall
I
that?
thought it was $1 million.
No, $1 million net worth.
Oh,
Or if you made.
I think it's 300, Mike. It depends on whether it's single or married, I don't remember.
I can't remember exactly. It's 200,000 single, 300,000 for a couple.
Yeah.
In 2 years.
In 2 years. Now, some of the areas, they let you just make a statement on that, so that's one of the, some off camera on that one. Depending on, who you're working with, some of them, you're attesting to your own abilities and they're not checking. Most companies are gonna ask, you're gonna look for documentation on that. But the Delaware Statutory Trust, you're exchanging a property, and in this regard, in my opinion, you're moving to a much more passive investment. Sears Tower in Chicago is technically a Delaware Statutory Trust. You're moving money in at $100,000 shares into usually a AAA class investment. Do you think the Sears Tower in Chicago is ever going to have a problem with occupancy? Whereas my house around the corner might during the next downturn. But so you're moving into that. It's a larger investment, Class A property. For our older people, where it really applies is a lot of times when we're exchanging, we also have to get a loan. If you have $500,000 loan on the property you're selling, you have to replace it with a $500,000 loan. If you're retired, do you still qualify for that loan? A lot of our people don't. But you've got the chops to be able to do a DST, and there's a number of providers, to where the loan's already on the property. So the other advantage of the Delaware Statutory Trust, the property is owned, performing, and the financials are known. How many of you like looking at pro formas and are going to bet your retirement on a pro forma? It's not pro forma, it's the actual how the material, how the properties are working. So you're moving into Class A property, professionally managed. Federal law does not allow the sponsor of Delaware Statutory Trust to quit. So they cannot run away and go south of the border. You don't have to qualify for your exchange loan. And because of, if you own 1% of, you get into a $100 million office complex and you own 1% of it, that's going to be mailbox money. Be very passive, yes.
Mike, do you offer DSTs?
On those, on the 1031 exchange, if you're getting a loan on the other side, commercial, I can do it. I do loans in California, commercial nationwide. I have one of the sources I work for DSTs, but I recommend, the DSTs you can also Google and find them because most of these people have been players for 30, 40, 50 years. And a couple of the other ones coming, but I'll mention those as well if I'm potentially one of the connectors for that.
So you're only doing the loan side of it, correct?
No, on this, actually, I'm tied in because it's a security that's being done.
Yeah, it's a security.
So it's, I'm connected with one company, defertax.com, that offers a limited number of DSTs. They don't do too many of them because there's a lot of big providers out there.
Right.
But there is potential source there, and then they compensate me for basically I'm out here marketing for them. So,
but not as a, you're not
Not
as a representative selling the security, correct?
correct.
Yeah. Okay.
Correct.
Got
Yeah.
it.
No. I get the guy with all the securities licenses and that resume to go along to work with. That's a great question. We're still using the 1031 framework, but this is a part of the 1031 very few people are aware of, and even less aware of where the potential strengths are. I kind of glossed over the 1031, the regular one, you sell a house and you go buy 3 in Florida, everybody kind of gets that one, so. For time, but anybody that needs any of that, me to back up and go over any of those in detail, including the 1031, we'll connect afterwards next week, next year. And for me, it's about the education, about you understanding the specifics that work for you. This is the high level, just knowledge. Deferred sales trust, this is another one that I work with the same people on, to where if you go with them, yes, I get compensated. It's utilization of an unincorporated business trust. This is where at close of escrow, the property you're selling goes to Jane, but before it does, it bounces through, like on a 1031, your property, the title actually transfers to the accommodator, and so Jane's money goes to the accommodator. In this case, we're putting it into an installment sale. The installment sale is how you avoid capital gains at the moment. And that goes into the unincorporated business trust. The unincorporated business trust is an investment engine. They have stocks, bonds, annuities, putting into the property. This is another way to get in and actually start diversifying a little bit out of real estate. Some of us are a little bit real estate heavy in our balance sheet. It is also for accredited investors, so you have to meet those.
This is the monetized installments?
No.
Oh, no.
No, that one's still coming.
Okay.
This is the other DST. I love it. We managed to come up with 2 acronyms in the same industry. It's really mind-blowing. Delayed sales trust. So what it is you're with this, you're moving forward. The 1031 and both DSTs, when you pass on, basis steps up. So everything ultimately goes to your heirs with a stepped up basis, which is a key thing to remember. How many people have heard of CRTs? They're actually coming back around again. I bet you've got more calls for CRTs this year than probably the last 5 years combined.
Because of the interest rate they're paying, it's excellent.
Yes. So charitable remainder trust, and there's 17 different ways you could spend these. Your property goes to the charity, you can still be living in the property. They call it a life estate. You could be living in the property and they're sending you some money every month. The charity knows at the end of the run, they're going to get the entire property. So there's, depending on what all the parameters are and depending on the charity. Because the trick here is the charity has to be set up to do this. I'm going to pick one, I actually don't know the answer, but it's like the SPCA is not set up to do charitable remainder trusts. But you talk to University of Santa Clara, you talk to Stanford, other organizations that you might give to. The Catholic Church is another huge user of the CRTs. And so you have a donation that you can write off. It's, if you're getting income from them, it's a passive investment, obviously. You just get a check in the mail, just like a Social Security check. So you could have income for life. And the driver being, at the end of life, of course, the charity's going to benefit. They don't have to wait, and it can make a difference in your lifestyle. I'm one that so many people talk about affordability. In my mortgage world, we talk about debt to income ratios. Now I'm on camera. Those are both bogus terms in my house. They don't mean squat. What does matter is your livability standard. And that's what I look at. So this is one that can change that livability for some people. Again, depends on what their plans are. But it is a way to move property and change their dynamics. On investment property, they're not having to manage tenants, toilets, termites, and trash any longer. They're not having to go, oh, I don't want to kick Janie and her kids out at Christmas time just because she hasn't paid rent for 3 months. We have landlords that are that way. And so, which is reducing lifestyle, and this moves it back through and into a more certain level. So again, certainty.
Mike, why are those coming back?
Many more people are trying to figure out how to get the heck out of Dodge. Healthcare has gone through the roof, and the it's not, the costs are not accelerating as much, but they're insane. They're running about 1.5x of inflation. And
Dodge meaning the United States?
no, I'm talking Bay Area.
Oh, okay.
Yeah, I'm talking. I have people with in-home care. They're spending $7,000 a month for the care providers.
Yep.
And I just had my dear 98-year-old aunt 2 weeks ago got moved into a home because, this will tell you a little bit about my family background. 98 years old, she picked up a hammer and threw it at the care provider. So care provider quit, needless to say, and her daughter, she had to show up the next day and move dear auntie into a care home, kicking and screaming. So I told my lady she knows what to expect in the future. But it's we're roll back for most any of us, roll back 20, 30 years. How many of you would have given yourself a 50% chance of hitting triple digits? Not me. But my 98-year-old aunt is moving into a care home with her 99-year-old husband after my dad died at 94 and his older brother died at 92, and I got a 94-year-old aunt that still drinks enough to total a brand new Corvette every 3 years. And my 98-year-old aunt gave up her license voluntarily at 96. These numbers aren't a joke for us anymore. And that's the one I mentioned the ages because think what's going on in our own respective families. This is the stuff we need to plan for. And so some of it is, this mailbox money thing could be a little bit more important. Monetized installment sale has been talked about now. What have we been running? It's about 4.5 years, Richard. Have we been running into the monetized four or 5 years thereabouts?
Yeah, that's a good guess.
There's actually 2 providers in the country that do it. I am connected with both of them. I choose to work with one versus the other, and the second one I keep around because, you know, for the odd ones I can't do with Plan A. Installment sales have been in the IRS code, I forget if they were in the code 10 years before the Starker exchange or 10 years after. We're talking the 20s and 30s.
2 years before.
10 years before. So the installment sale has been codified by the IRS before 1930. This is marketed as a single solution, and that's the error. This is 2 transactions. And then after explaining how these 2 transactions work, it makes the delayed sales trust a little bit clearer because it kind of moves down the same train tracks. And the reason we're doing these is as long as you don't receive principal, you don't have to reconcile capital gains. It's not the sale of your property that triggers tax reporting. It's receipt of principal. So if I buy your house, 0 down for 30 years, interest only, you have no capital gains to report because you haven't received any. So we start out with an installment sale. The property still gets sold to Jamie. This is, you know, we have the mechanism to where the property steps, you know, you sold it to Jane, but it steps through an installment sale and then goes to Jane. So Jane's money funds the installment sale. In the installment sale, you're receiving interest, and we know interest income, we pay taxes on. No biggie at the moment. Wait, there's more. But that's all we're doing with the sale. And that's all you're reporting. Your sale's done, just like a 1031, just like anything else. You've sold the property, and you took back a whopping big note. So there's no capital gains to pay. Period, done, end of story. Now, the idea here was not to get an income stream. We don't use the monetized installment sale to get you interest payments on that note. That's not the end game. We have commercial banks that will loan you that money. No qualifications, non-recourse, no personal guarantee. They will loan you back 100% of your proceeds on that house. And no, they don't know you, they don't want to know you, and they don't care. They're loaning it to you because their guaranteed payment stream is what's coming down from the installment sale note. They know who actually got the money and invested it. They know this income stream is solid gold. So we just run it through a long-term escrow, and it cycles right through and pays your note. If this person that is paying you ever blows up, you have a note that has no personal guarantee, non-recourse. The note vaporizes. You never have to pay it back.
Is there any restriction on this, on the buyer?
No, just like a 1031.
So
The buyer doesn't care that you sold the house to him, but on the paperwork it looks like the exchange intermediary sold it to him.
Well, my kids can't buy my house. Would that qualify?
They have to have the money to buy, they have to have the money to buy your house. Somebody has to be buying a house, just like on the 1031 exchange, when you sell the house, you're transferring the title to the accommodator. Yes, you sold the house, but the paper trail, it's the exchange accommodator that actually sold the house to your buyer. Does that make sense? So the buyer's money is what goes to the exchange accommodator. Here, buyer's money goes and funds the note because you didn't touch a penny of it. So you get the note, you have an interest income there. And then we've converted it to cash. commercial loan involved, make no bones about it, there's 6.5 points on that loan. So if you had $1 million net, you're gonna be paying $65,000 in fees, you actually get $935,000 cash in your hand. But no 1031 timelines, nobody else managing your money but you, and no $350,000 check to Uncle Sugar and cousin Newsom is the benefit of this.
Nuisance.
But I said before, you have interest income coming in, and so that's, you don't see it, but you're getting, you're logging it on your tax returns in order to pay taxes on it. This money that you received, you want to invest in. And you want to track what you put it into. It's not go out and buy a Tesla and give it to daddy or give it to the kids. That's called boot. You wind up paying taxes on what you skim off the top. But you invest it. But there's no restriction on the definition of invest. You can put it in Bank of America savings account and getting 1%. They are going to be paying you investment interest income. But what we're trying to do here is you're taking this lump sum and you're investing it, doing whatever you choose to do there. But because you're investing it, you can write off the payments on your note to counterbalance the income from the installment sale.
Yeah, that part is always a little confusing to me. If you just take the money and put it into a checking account, it's considered boot.
If you take the proceeds from a sale,
Okay.
but and actually putting it, as long as the account pays interest.
Well,
if
that's
you-
what I'm saying. Let's say it's a checking account that pays 0. Why is that?
Then that's considered boot because you have not invested the money, so you can't write off this loan. See, I can take a loan against my house and spend the money on a rental property in Oklahoma. I do not write that loan off against my house. That's technically not right.
Right.
I can write that loan off against Oklahoma.
So, sorry, say that again.
So-
You took a loan out against your primary property and then invested in Oklahoma.
Primary property, investment property.
Okay.
We're talking, we're talking a bit of the tax code
Yeah.
and how you allocate things.
Right.
The definition of investment is investment expects a return. You can lose money, you can go buy stock, make money or lose money, you're still investing the money. Putting it in $100 bills in a safe is not an investment. So you just simply have to be investing the money. But the trick here is, this is the one strategy that gives you the most bandwidth for potential diversification. You do not have to go buy real estate. You can buy stocks, bonds, gold, business. And this is also, another kicker on this. Businesses that are being sold. They can exchange the sale part of the business, that's the building, but they can no longer exchange the goodwill of the company, the inventory, the equipment, but with this we can. Because this works both on owner-occupied and non-owner, so it's broader.
I guess the part that's confusing, Mike, for me here is that the loan that you get, you receive that loan as a private investor, and they're going to charge you. Sorry, there's an interest rate that you would have to. Actually, you don't have to pay the interest rate, but
The interest is paid from
From
your
the-
installment
from the installment.
contract, yes.
Right, but I guess, why does it have to do with now investing the money in a in another investment that, I mean, cause it's,
Okay,
in
yeah.
a business.
Yeah, because what I'm talking about is making what you're doing here, tax liability neutral. Because if you take this loan and just stick it in the bank, you can't write off the interest, but you have interest income landing on your tax return. So if you're getting $100,000 a year interest income, I want you to be able to write off darn near $100,000 of, what's on it? Investment
Expense.
interest
That's what the interest
expense. Schedule A of the tax form, line 17.
Okay. It has to go through the
I beat off
hurdles.
line number,
It
but it
has to go
says investment interest expense. That's the block where you write off the payments that are being made on this loan. So you have income coming in
Gotcha.
and you're writing off. But in order to write it off, you need to fit it on that line, and the line is titled investment interest expense. So that first word is what gives us the definition of what we have to do. It doesn't say that you cannot put it in a savings account. There is, I don't believe, I have not run across, and if anybody finds one, please forward it to me. There is no list of approved investments. So you can buy a business, you can buy collectibles, you can buy horses,
Right.
all kinds of things. Us real estate junkies, we go buy more real estate because I don't like the 1031 timelines. I also don't have heirs. So my tax bill going 30 years down the road, I don't care. Uncle Sugar can figure out what to do when I'm dead and gone. You know, that might sound brash, but you know, everything we're doing, when you're talking about estate planning, you're talking about what's gonna happen when you're dead and gone. You know, that's part of the conversation. You know, if you have kids, they're gonna get that tax bill. Whereas a 1031 exchange, when you die, then everything steps up. I like this. I was looking at doing it last year because I have a note on an investment property that I'm unable to refinance. I could take the proceeds and replace that note. It's still an investment. I could build up my stock portfolio. And go out and work on flipping another house, put in another business, any one of my other businesses. So that, you know, so there's advantages to this here. And the mismarketing on this is everybody keeps trying to kludge it together and make it sound like a one deal. And it's two transactions. As soon as you grasp it's two transactions, you understand all of the benefits of the exit. That note, because again, it's non-recourse, you know, the note payments are made, you know, which I talked before, it just passes through. And you don't have to make the payments, you don't have to worry about it, was a payment made, did it go through, because it just automatically goes through long-term escrow. You pay like $300 a year. The monetized installment sale, you do not have to be an accredited investor, but we need to be moving at least $500,000 or more through the process. The largest monetized installment sale done to date was in 2004, and it wasn't Staples. I'm going to use Staples, it's a similar company. In 2004, said office product company sold to Weyerhaeuser $1.5 billion of timberland with a basis of 0. What's the capital gains taxes on that puppy? It was $500 million tax bill. They did a 15-year monetized installments. I'm actually going to be talking to my buddy tomorrow that helped structure that to go, did they just extend it? The benefit was the office company had access to all of that tax money for the past 15 years to roll it, to parlay it, to do things with until the final payment goes through. Is anybody here making as much money as they were 30 years ago? Richard, you can't answer that. I pick on him anytime he's in the room. It's called inflation. You're gonna be dealing with your tax bill 30 years from now, with money 30 years from now. Your rents are, the rents you're receiving are gonna be 3 times what they are now, the property values are gonna be 2 to 3 times what they are now, and you're dealing with the same old tax bill that, you just put it on the books 30 years ago. The whole upshot of tonight was not about, whether to do it or not. Getting the conversation going. What are you trying to accomplish? Let's look at what tools can help, what tools might not work. There is no right answer, there's no wrong answer. But I firmly believe that if you're making decisions from a broader base of knowledge, the decision you land on, you're gonna be more comfortable with and sleep better at night. It might be the same decision that you would have made on a base here, but it's just, this is dealing with how we feel. Failure points. I've done them all. Yes, they all are number 1. Because if you do one of them, it's gonna hurt like it was number 1. Big one. I'm just a source of information, and I'm happy to share other resources so that you can double check. Talking about the line item on the tax form, you all can go check it out yourself. Oh yeah, I'm a mortgage. How many people have had a loan get done faster than they thought it was going to take?
No one.
Yeah. Welcome to my world. It'll take what it's going to take. And so, so when we're talking about the 1031 exchange, and we're serious about that, about those timelines. This is the handout I have, which is just the clip chart. And actually, Richard, if you want to run this around. Because I don't expect you to remember 10% of what I said tonight. But if you have an idea, because we're talking about which ones you have to be an accredited investor. If you're not accredited, guess what? You don't get to play on those 2 line items. Owner occupied, because are we selling a personal residence? Are we selling investment property? Investment property, yes, all of these strategies work with investment property. And the other one that I like to point out is, what's your end goal? Is the goal of the exercise to go to cash? Or is the goal of the exercise to go to another stream of income? So the reason I like the Monetized and talk about it so much is it's the only other strategy I know where you can go to cash and not just another stream of income. Just about.
I'm curious, it's a question for Richard. Richard, have you had any of your tax clients as an EA go through the monetized installment sale?
I've had several, we've had both, monetized and deferred sales trust. They're just installment agreements is all they are.
Okay.
Yeah, they're all based on,
Well, the deferred sales trust seems to me like it's been around a little bit longer. The monetized installment sale, and my understanding is, at least it seems it's like the qualified opportunity zone. There's potentially, like I guess a
well, with the deferred,
potential audit risk.
with the deferred sales trust is, whoever you're working with as the advisor inside of the trust would have to be working in opportunity zones. And right now, I don't know too many that are. There's many of us that are afraid of the term OZ. I frankly admit I'm one of them. I know too many people who went bankrupt out of the last opportunity zone that this country put out. Wasn't called an opportunity zone, but was structured very much. Anybody remember the GO zone?
Go zone, yeah, Louisiana.
Yeah, that didn't end too well for a lot of people. So I have a lot of fear around the OZ because it's just too new. It's just too new. I have a friend of mine that, another commercial mortgage broker that speaks extensively on specifically the operating, the OZs. And he comes out of the financial planning world, so he's been digging into the terminology and everything else, and so it's one of those, I go, you know, I just turn people over to Marty. I don't have time or interest to learn it, so I frankly admit that. I don't want my beliefs to color anybody else's. I'm just one more huckleberry here. But yeah, the delay sales trust, you know, it's also for the accredited investors. It has diversification options built in, but it's also moving to a lot more passive. To me, the monetized is, you know, my, you know, joking quip, yeah, it's as passive as, you know, does the phone ring and interrupt me at dinner? Because I'm gonna be investing the money in something. So you know, I invest in real estate, so I expect the midnight calls. I invest in businesses. So, you know, shipment, you know, trucking company says, aren't you thrilled we just delivered your pallet? And we're going, y'all haven't even picked it up yet? So try to fit, you know, crazy stuff like that in. This is basically what I do. You know, the DSTs, the MIS, there's a potential there if I'm assisting you in introductions and getting that lined out. I am actually the one that writes the Monetized. There is a potential for me to get a paycheck there. I don't hide where my bacon is. This is an educational thing. It's about opening up the conversation. I'm happy to talk with anybody about all of them. And I'm thrilled and clap for every one of my potential clients that have decided to sell and pay Uncle Sam. My job is not a specific outcome. My job is to help you all, help the clients understand what options are available so you can make a choice for yourself. Because whatever choice you make for yourself, that is the right one. Oh, the honey company, that was that trucking thing. I had I had 4 barrels of honey coming out of Texas, and they told me it was delivered, and we're going, you bozo haven't even picked it up yet. You told me it, and you said it's here. Oh God, that was a mess. But any of you tea drinkers, if you ever run across horseman honey, try it. We're the only people that have it in California. But I do talk to people about do-it-yourself credit repair. You know, that's just a personal grind of mine. You don't need to pay somebody to fix your credit. You're going to pay them money to take 15% of the work off your table. I'm one of those. Why? Do it yourself. I love discussing challenging projects. One of my regular, you will call me at least once a week.
Yep.
You'll call me from the beach in Hawaii, which I always laugh at.
You know, Mike, that's really important that you have somebody, you know, you go to a seminar and you find some technique that Mike is talking about. Well, obviously, there's a lot more behind what you're seeing here. So if you're gonna do some of this, please talk to somebody and get some advice on it. You know, don't just talk, I think Mike said, don't just talk to one person.
Yeah. No. And on the back side of the handout is all of my contact information, you know, the LinkedIn, the Facebook, all of that stuff. I do my version of a blog. I send out 3 emails a month. My main one on the first of the month has a section in it called the good, bad, and the ugly. So again, I wear cowboy boots with a suit, so I'm pretty even-keeled with everybody. You know, and I call it out like I see it. You know, Richard's been getting it for years. It's just information in the marketplace. A lot of times I'm running, it sounds like I'm running counter, but that's really it. You all are getting the mainstream media headlines. What's the rest of the story? What are the counterpoints? My favorite one, I just picked up the latest numbers for carbon dioxide production in the U.S. We are actually up 2.9% this year. But over the last 14 years, we're still down 13% from the amount of carbon dioxide this country was producing than 14 years ago. We're the only industrialized nation in the world that has been reducing CO emissions while our population has still been growing. So we hear about all the global warming, we need to do more, we need to do more. Trust me, guys, we are leading the charge. And it's stuff like that that I bring out, you know, not just talking about I don't talk about what the latest loan craze is. I work with clients to figure out what are the options for you all, and I'll let you all decide. You all tell me what the hottest thing is for you. But that's me. More questions? Do we have time for some more
Yeah, we
questions?
do. 20 more minutes until 9 p.m.
20 more minutes. Yay.
Can we get a presentation if we didn't bring the business card? I know, we'll just contact you?
Yeah,
Okay.
yeah, absolutely, oh, absolutely, yeah. That's, there's nothing proprietary on there. Like, yes, sir.
If you're doing a 1031 exchange into a tenancy in common, and you have debt from the property that you sold, do you need to have debt allocated to you in the new tenancy in common?
Yes, you do. If you're in a 1031, if you exchange out of a property with debt, then you need to replace that debt. Or, that's called boot, which is real ugly because you just exchanged all your cash and forgot to exchange that $300,000 mortgage, and he's gonna go, you're gonna have a bad day, son.
But you can replace debt with more